Thank you very much, Antoine. So I'm Nicolas BEAUGRAND. I'm very pleased to be here this afternoon. I'm a partner and managing director at AlixPartners in Paris. AlixPartners is the management consulting firm for private equities. We support our clients, private equities and their portfolio companies in the pre-deal and post-deal value creation, and also on their operational transformation journey. I lead our private equity offering as well as our ESG and sustainability activities in Paris. So I don't think, if we think about the context we are in, anyone who has worked in private equity in the last decades would argue the fact that we are facing the most challenging economic period that we've seen. And for the reasons that you see on the, behind me on the page, and I'm sure you've all faced all of this in the last 18 months. For such level of market disruption, that means LPs and GPs need simply to adapt and to reevaluate their strategies to some degrees. With the key questions, how will LPs demand shift over the next 12 months? How can GPs stand out from the crowd? How will they take advantage of any emerging trends? And if I may, the good news is that AlixPartners, in partnership with IPEM, has developed a report containing exclusive insights around allocation, around fundraising trends for the next 12 months. Our data has been gathered from the 2,000 of all of you who are here this week. And based on this was providing a snapshot of your investment strategies, of your trending sectors, of the key strengths desired and offered by investors or by the funds. And I'll be running through the key messages and key findings of this study in this presentation. Of course, the full report will be available at the end, and you can drill down into more detail as you wish. And some more good news to start, I would say. The good news is that despite all the macro conditions I've mentioned, we see the market is still active. We estimated around 140 billion of funding in Paris here this week. Sorry, I think I've been too fast with the slides. Okay. Now, looking at our research suggests that already 44 billion will be allocated to primary funds, first finding, and more than half of these will be allocations between 20 and 500 million. Interestingly, almost half, I would say precisely 45%, of the LP investment will be focused on new allocations versus the re-ups, which may be, I think, a reflection of market shifts and the hunt for new opportunities. Of course, this split varies across the investment strategies. We see some more details, but clearly the new allocations are higher and above 50% in some segments like private debt, like real assets, and more specifically funds of funds and secondaries offerings. So now, where LP appetite is the strongest? The helicopter view. First of all, the private equity leads the way of the PE interest, right? Followed by the private debt, and then the venture capital. And looking at each of them, the buyout are the most popular target strategy in private equity, while the private debt is the top for, in private debt, the top is direct lending, and in venture capital, mostly the strategies are late-stage growth, and for real assets, it's infrastructure. From the study, we were also able to build a picture of each individual LP type and creating a snapshot of each of these, showing their target intentions, the target sectors, the main amounts allocated, and the critical needs for GPs over the next 12 months. I won't go into the details of each of these. You will find them in the report, but 3 key takeaways overarching all these snapshots. The first takeaway, the small and mid-sized fund managers will capture significant investor interest for the years ahead. The second, the key strengths that LP wants to see from the GPs are, I would say, above all, and no surprise on that, the consistency of return, but also the alignment with LP interest. And the third overarching message is about the sector view. The top 3 sectors that are targeted are, number 1, technology and software, number 2, healthcare, and number 3, the business services. Now let's look even more closely to the data. In every industry, understanding the balance between supply and demand is very critical, and private equity is not different. So this is the exercise we have run on the data. On the slide, you will see a ratio that shows if the demand or the supply is greater and to what extent. So that's these bars and these numbers. Our data shows some crowded area with high competitive area for the GPs, as well as white space opportunities where LP demand is far greater. And let's see the key finding. The first finding and the most distinctive is that the secondaries appear above all to have a significant untapped potential and across all the strategies. And for those of you who heard yesterday Steven Schwarzman from Blackstone, that was also one of his key messages, apparently. And this ratio, when we zoom, it goes up to 2 to 1 demand over offering for both private equity and private debt specifically. Other white space, within the real asset, natural resources is also clearly appearing as a white space, as well as turnaround and restructuring, where offering from GP appears currently to fail to meet the interest of LPs. On the other hand, the data indicates that fund of fund and also development and minority spaces are becoming increasingly crowded. Now let's look sector by sector. What do we see? Well, first we see a more balanced picture. Communication and media offering stands out and appear notably underrepresented by GPs versus the LP demand. And on the other side, we see technology and software, so the top 3 segments, technology and software, business services, as well as consumer goods, that are moderately overserved. Moderately. In the tech space, clearly we see a surge in artificial intelligence offerings, which exceed LP demand by around 25%. And at the opposite of the scale, we see Web3, blockchain, robotics, agriculture and food tech, biotech and medtech that present greater demand from LPs, that is to say, opportunities for GPs, what I call white spaces. Now that we've seen where the opportunities lie, the question is, how can the GP stand out from the crowd? How can they differentiate themselves? Our data tells us, and I'm smiling, that LP value performance above all else, and in particular, the consistency of return and the absolute performance. Okay, you will tell that there's no surprise here. I would say LPs are LPs, if I may. However, looking at GPs, they place a greater emphasis on the value creation approach, and also on the sector or the geography expertise, even before performance metrics. We also see very interestingly that ESG conviction is a very important selling point for GP. As you can see, ESG stands out from the different points, and the interest of LPs is only matched to the GP interest for pension funds, for sovereign funds, and for foundations. We also see that ESG interest ramps up and becomes greater as you decrease the size of the segments. And below 500 million, you've got an increasing interest for ESG. And we see a similar pattern when looking at sector-specific and geography-specific expertise. The importance increases as we decrease the size of the segments. I hope you agree that this data is fascinating, and you will find plenty more detail in the report. I wish, hopefully, that this data becomes an important barometer for the years to come, that we can compare year after year and the year to come. My personal take for this year's finding is really that driving value creation and protecting value has never been more important. Of course, LPs are looking for performance. GP wants to deliver the performance, and it has been made much harder by the economic headwinds, of course. Optimizing capital structure has been and is not as powerful ever as it once has been. Clearly, the operational excellence is increasingly critical in value creation. The focus on cash, the focus on cost efficiency, on operational and supply chain performance, on digitalization will all be vital for building those value stories. And with this, ensuring the ESG transition will be also key. And let's not forget that clearly the attraction and retention of the very best talents to steer the business through the challenging times is also extremely important. And in conclusion, all these points, these are all the muscles that must be strengthened, and they will be needed for the times to come. I'd like to close by thanking all of you who contributed to this report with the data provided. And as I mentioned earlier, you will find the full study now available, was not before, but now available on the IPM website. And you can download it also using the QR code here that you see on the screen. I hope the conference was for all of you an energizing experience for all the week, for this session and for all your sessions. I thank you very much for your attention, and I hand over to Antoine for the next of the session.